From 2010 to 2021, central bank gold purchases showed a predictable baseline as institutions prioritized liquid digital assets. That changed in 2022. Accumulation reached record highs with a vertical spike, and projections suggest buying continues at these levels through 2026. Emerging market central banks are now liquidating U.S. Treasuries to clear space on their balance sheets for physical gold. They are now trading the world's most liquid debt for the one with no counterparty risk. This shift signals that major institutional holders are preparing for a period where ties between global trade and the dollar are no longer a certainty. They are moving into hard assets to insulate themselves from a structural change in how energy and goods move across the map. The unilateral dominance of the Western financial system is experiencing a physical challenge. While public focus remains on inflation and interest rates, sovereign nations are already building the infrastructure to operate outside the current system. To understand why these banks are exiting, we have to look at the mechanics of the system they are leaving behind. In 1974, a landmark agreement was reached where Gulf nations agreed to price their oil exports exclusively in U.S. dollars. The second half of the deal required those nations to take their oil profits and buy U.S. treasuries. In return, the United States provided massive military security and advanced defense hardware to protect the region from any external threats. This arrangement allowed the United States to fund large deficits, because the rest of the world was effectively forced to buy American debt. As long as oil was priced in dollars, every industrialized nation had to hold U.S. currency to keep their economies functioning. This created a mandatory loop. Energy demand became the floor for the value of the dollar, regardless of how much currency the U.S. Treasury actually printed. For 50 years, American economic influence was maintained by this specific link between currency and the global energy market. That link is being severed. The pressure started with physical trade routes. When traditional choke points like the Suez Canal become volatile, nations are suddenly forced to reconsider the safety of their supply chains and the exact currencies used to facilitate them. As the equatorial waters become more difficult to navigate, the world's leading global powers are actively looking north. They are investing in ice-breaking fleets to secure new, shorter trade routes through the Arctic, creating a physical bypass of the old maritime order. This physical splintering has financial consequences. Saudi Arabia recently allowed its 50-year Petrodollar agreement with the United States to expire without a formal renewal. Following that expiration, Riyadh began exploring oil settlements in multiple currencies, including the Chinese yuan. The era of oil being priced exclusively in one currency has ended. At the same time, the BRICS coalition has expanded to include the world's largest energy-producing nations. This group is no longer just a diplomatic forum, it is a coordinated economic bloc. They are currently deploying digital systems like Project Enbridge to settle energy trades instantly across borders, completely bypassing the Western-led SWIFT network. These systems prove that when trade routes change, the financial rails change with them. Emerging markets are no longer required to exclusively use the US dollar to participate in the global energy market. The US dollar is not going to vanish from the global stage overnight. It remains the most liquid market in the world, but it is losing its status as the world's only viable financial option. This transition is making inflation structural. When trade routes are longer and energy is priced across multiple currencies, the low-cost era of the last decade becomes impossible to maintain. Central banks cannot solve this through monetary policy. You cannot lower the cost of a shipping route by printing more money. In this environment, traditional portfolios concentrated in domestic bonds and index funds are facing a sustained loss of purchasing power as geographic risks increase. To adapt, capital is moving into hard assets. There is a massive rotation into the industrial companies that extract rare earth elements and the physical infrastructure required to build regional supply chains. At the same time, investors are diversifying their legal jurisdictions, holding assets across multiple currencies and using AI to dynamically manage the logistics of a fracturing global market. Geography has become a risk that cannot be ignored. The global map is being redrawn, and for those managing capital, the priority is now matching their assets to these new borders.